Hey there, my name's Curtis Lucas and you're watching Empire Building. In this episode, I'm going to be talking about why I am so bearish as of late on this channel. Anyone that's been watching any of my most recent videos knows that I've been bearish for the last couple of weeks or so. Now, believe me, I fully realize how unpopular of a topic this is, but with the information and the reality that I see in this market today, this is just something that we simply can't just ignore. And we need to be aware of the conditioning that we may have been subjected to over the last, say, 10 years in this in the stock market, where buying the dip has been a very rewarding strategy. But we also have to acknowledge that there have been periods in our history where that's not always the case. And we need to at least acknowledge that there's a risk that this practice may not bear fruit much longer. So I'm going to guess that if you're still watching at this point, that means you haven't already clicked away from the video and left some angry comment and unsubscribed from the channel, as some people have been doing as of late because they don't like what I have to say. Now, fortunately for me, I don't choose what I say based on what I think people will react to. I choose what I say based on what I know to be true, and I'm going to keep doing that. So if you've got an open enough mind, then perhaps we can have a conversation about this. I'm all for debating this theory. In fact, I've been engaging in that sort of healthy Discord on my Discord channel with all of my Patreon supporters. We talk about these things all the time and share different theories. We don't all have the same viewpoints, but this is what we engage in on a daily basis, trying to understand what this market means. That's a community of like-minded empire builders. I treat it like a think tank that basically challenge each other's ideas and try to just become better at what we do. It's remarkable how much more balanced a viewpoint you can have when you've got other sounding boards to bounce your ideas off and see if you're on the right track or not. So if there's anyone that would be interested in joining that community, check out the link down in the description and head over to Patreon. You'd be supporting the channel, but also benefiting from this rather remarkable community. And one more thing I want to mention before I get into the rest of this topic is that there's a video I'd like to share with you guys. The link will also be down in the description, where I was featured on Viridi Funds sort of monthly mining roundup. Myself, as well as Blonity and Random Investor and Mike Wainwright from Twitter, were all a part of this with members from the ETF fund manager. That would be Viridi Funds. They run the RIGS ETF. Great group of guys over there. And we're looking at maybe making that sort of a monthly event, but their YouTube channel is a lot smaller, so I figured I'd at least feature it on here. Go check it out, subscribe to the channel, hit the notification bell so you won't miss those videos as they come out on a monthly basis. But I'll try to remind you here after we upload some of those. And you can also follow me on Twitter, where I'll be definitely posting that after those videos go public. So back to the main topic, buying the dip. This is what I mean when I say that we have been conditioned and rewarded by buying the dip. This very simple strategy that has always rewarded us for doing so. Over the last 10 years or 12 years, you couldn't really go wrong with that strategy. All this market wanted to do was go up. And it's worth asking ourselves what might be the reason for that. And the reason I would suggest is the age-old wisdom, don't fight the Fed. The Fed has had our back this entire time, with slight reversals that actually did see market downturns, but it turned out that the Fed did not actually go against us. The last time that happened was this massive drop here at the time was pretty gut-wrenching. But following that, when the Fed realized they didn't have to raise rates, they went back to lowering rates because they realized that there wasn't any risk of inflation. So the market rallied and continued to surge higher. Obviously, we had the COVID scare, which again was responded by lowering rates to nothing and massive amounts of money printing, or quantitative easing as we call it today. But the reality is, this is coming to an end. Earlier this week, the Fed officially ended their quantitative easing practices. They are no longer expanding their balance sheet. They're no longer purchasing those mortgage-backed securities and other assets. And on top of that, they're going to be raising rates. So when they say don't fight the Fed, that goes both ways. And you can see that we've been in an incredible run since the Fed really started acting in a big way. We've seen this massive rally that's pushed us way outside of this channel here. Now, it doesn't take a genius to realize that this is probably not sustainable. So we probably should have been able to realize that our days were numbered here. And I mean, maybe it helps maybe from time to time to take a step back and look at a trend like this and try to understand what it might mean. Because when you look at this, it becomes pretty readily apparent that things were pretty overcooked, overdone. But this is a very long-term trend here. And there's really only one other time that we've witnessed something like this in the NASDAQ. And this was the dot-com bubble. It basically did the same thing, only to a much further degree. Obviously, the economic conditions back then were somewhat different than they are now, and the dot-com bubble was something very, very new. But obviously, certain lessons we don't learn all that quickly. And what happened after this? Before we get into this, I do want to preface this with the fact that I'm not saying that what we're witnessing today is in any way the same, identical to what was happening here. At this time, we had a lot of companies with extremely high valuations that basically had no product and no real sustainable business model. Today in our markets, these are real companies with real revenue streams and real products that are extremely profitable. So it's not all built on top of smoke and mirrors like it was back at this time. So we're not going to see the same extreme circumstances. But what is worthwhile looking at is we knew how this played out. Even the initial drop, which was severe. I mean, the thing that people are going to constantly refer to is how much our prices have come down from their peaks. And honestly, you have to be careful with metrics like that, because this original drop from the peak of the NASDAQ was a 40% fall, which was crazy. I mean, right as of today, the NASDAQ is down about half that, just over 20%, which puts it into a technical bear market for the NASDAQ. And then, yeah, we saw another rally, but even, never mind measuring from there. Let's say you did panic sell at the bottom here and was smart enough not to go back in despite this rally. If you had done that, you would have saved yourself a further downside of an additional 63%. So that's the thing about percentages. You can fall 50% many times over and still not be at zero. So again, like I said at the beginning of this, I'm not suggesting that we are going to repeat this situation. What's happening today is very, very different. And the conditions that we're faced with are also very different than they were back then. There's a lot of things that I can talk about, and you've probably heard a lot of them by now as to reasons why this market is probably going to head lower and why this pain isn't over yet. And they're all very good reasons. And rather than trying to figure out what's going to send this market lower, I started trying to answer the question, what would send it back to all-time highs? Because if that's not a feasible option, then the best case you have left is a sideways move. In which case, there's no reason to be getting overly excited, because if that's your best case, then odds are, in balance of probabilities, you're going to see lower prices in due course. And I also recognize that it's this conditioning that we all have of buying the dip that we just can't stop ourselves from doing, despite the fact that we should know by now that we're in for some pretty rough times ahead as investors. The Fed simply does not have our back anymore, so you cannot count on them to come and bail us out. Their mandate is not to make sure that your account is in the green. They have three things that they're interested in: full employment, stable prices, and maintaining inflation at an average rate of 2%. We're way above that right now, and they knew this would happen. They planned on this, but Now they need to figure out how they're going to bring it back. This week's year-over-year consumer price index came in at an increase of 7.87%, the highest it's been in 40 years since the early 80s. And I cannot count how many times I've heard people say that if the market gets in trouble, that the Fed will just turn on the money printer again. No, they won't. That'll just make a bad problem even worse. And counting on that is a very poor strategy. What I'm trying to stress here is not about timing the market. That is not at all what I'm saying here. I'm still invested in this market. But I do have to assess it and take steps to manage this risk. This is a question of risk management, not timing the market. So you should size your positions appropriately given the circumstances. Another common misconception that people are looking at is, well, in a high inflation environment, Bitcoin should do well because it's an inflation hedge. But the data doesn't support this theory. We've seen it time and time again. Now, this is true. If you look at Bitcoin over a long period of time, say 10 years or its entire life, yeah, it works as a pretty darn good hedge against inflation. But that doesn't make it an inflation hedge in terms of as an instrument. Not like gold or other mature markets. Bitcoin is still a baby as far as that's concerned. And that's really not what it is today. That's not why Bitcoin's price goes up. Bitcoin's price goes up because it is a rapidly growing monetary network. And the value of that network is a function of the number of people or nodes that are on it. This is known as Metcalfe's law. Basically says that the value of the network is proportional to the square of the number of nodes. This is why Bitcoin grows exponentially in value, because as more people join the network, the value of that network becomes greater. It's not because it's a hedge against inflation. That's just sort of a nice side effect, but it's not how it behaves as a financial instrument. We have to understand that and accept that. Which is why I haven't turned around and sold all my Bitcoin and Ethereum. I still have a long-term outlook on that. And even if we do trade sideways or even down for a couple of years, I'm okay with that. But that doesn't mean I have to remain completely, fully invested on all fronts. It just doesn't make any sense. But also because I'm going to be maintaining those core positions, it means I get to take advantage of other opportunities as they present themselves. Because while I do think we are going to trade sideways and potentially down further from time to time, that's going to present some incredible opportunities to make some macro trades, which I would not be able to capitalize on if I remained 100% invested. So my strategy going forward is going to be this: maintain a core position, which I will continue to add to with profits that I'm hoping to make from the trades that I engage in as this market moves up and down over the next couple of years. Because I do think that it is going to take at least that long for this to play out. There's a very strong probability that what we are going to go through is going to trigger a significant prolonged recession. And there's not a whole lot that we can do about it. Now, I'm going to be careful at making too many predictions of exactly how all this is going to play out. But I do know that when you consider the conditions of this current environment, they are not conducive to new all-time highs. You cannot compare it to any period throughout the last 10 years. We are not playing with the same rule book. The money printer is off. It'll probably stay off for some time. And this soft landing that they're attempting for this market is, I'm just not buying it. If these market conditions were moving slowly and they were responding slowly, then I could understand that. But these things are moving rapidly. So responding slowly to something that's moving rapidly, you're not going to catch up to it. We're going to see continued inflation until they basically have to start clamping down much, much harder. But again, it's not all doom and gloom. There's going to be places in this economy, there's going to be little miniature bull markets here and there. So our job is going to be to find those. One of those shining lights, in my opinion, is going to be Ethereum. As many of you know, I'm a huge Ethereum bull, more so than even Bitcoin at this time and place, considering what Ethereum has in its near-term roadmap with the merge coming sometime later this year. I don't know. Currently, it should be around June, but it could be delayed. But I do think it will certainly happen this year, and that is going to change the game. This upgrade that Ethereum is about to go through is by far the biggest and most substantial upgrade that any blockchain has ever attempted, ever. This cannot be understated. Obviously, that does present certain risks because there's always the chance that something could go wrong. There could be a bug in this code. It possibly might not go the way they anticipated. That's the reality of dealing with these kinds of open networks. And there's tons we can talk about that, and I am going to be doing more videos to try to explain what we can expect as these developments continue. I'm a participant in that network. I run a validator, so I'm paying extremely close attention to this. But it's something I'm very excited about, and it is, like I said, it's the one bright spot that I've been able to identify that I'm very bullish about. And my hope is that will inevitably bring Bitcoin up along with it, but I don't think it'll be to the same degree. And there is a risk that because of Bitcoin's carbon footprint, if we're really going to get into that, that some people will view it as a negative. And I'm a little fearful that it's going to turn very tribal. And I find myself in the middle because I admire both networks. I'm a participant in both networks. And I've never looked at them as competing, but a lot of people do. So this is something we'll have to evaluate as time goes on. But all the same, if you're looking at where we could potentially make some money, then you kind of have to put all that tribalism aside and just base this off of what they are and make decisions that are not based on emotions. Bitcoin miners are still something I'm going to be interested in, still something I'm going to be actively trading in and actively holding. Like I said, I'm still going to have some core positions in them, but I am looking to be able to accumulate that on a slower basis as this sort of plays out. I'm looking for a higher capitulation event. I expect that Bitcoin will probably retest $30,000. And there is, depending on the sequence of events and what happens around that time, there's a pretty good chance it will break it this time. And hopefully, honestly, I'm hoping that we can actually spend an extended period of time below $30,000 while this market starts to mature and these Bitcoin miners have this opportunity to expand their operations, let the big ones get even bigger and build up their hodl positions so that when we do take off again, they're going to move fast. So that would be a best case scenario, to be honest. If we could play this out along those lines and give these companies a chance to show what they're capable of doing. Because the math does support these as a long-term investment. If Bitcoin does indeed drop like I'm predicting, this is very bullish for Bitcoin miners, especially the ones that have managed to reach scale. Those business models can be sustained indefinitely. And I'm going to be doing another video about that topic in particular to explain exactly how that works. It doesn't matter how far down Bitcoin's price drops. The miners that have reached scale, and by scale I mean ones that have a clear roadmap to getting above 10 exahash. That would be kind of my benchmark. As long as they're able to do that in this current calendar year, they'll be fine. But there's a lot of math that goes along with that, so I am going to save that for a different video. But yeah, this is where my head is at. This is what I'm thinking. This is my strategy going forward. Another thing that I'm considering right now is taking one of my accounts and sharing all of my trades and positions with Patreon supporters. That way you can see every move that I'm making and you can follow along with that account and see what I'm doing and how that performance is going. Obviously, as with everything else, none of this would be investment advice, but I do think that it would be kind of interesting to remain accountable and show exactly what it is that I'm doing as I'm doing it. But I want to do a little bit more research into how I might set that up. So stay tuned. I'll have some announcements for that in the near future. But that's it for this one. Now let's just get back to empire building.